What do you think most prices actions in the market from one value area to another? Is the unfiltered orders to the smart money. Today I'm showing you how to make the advantage of these orders and how to combine supply and demand zones with the trading indicators to find the best signals. So if you could like and subscribe to the channel and stick around for the full video by analyzing supply and demand, you basically try to anticipate where the unfilled orders of the smart money are located in the market. The plan is to enter the market where the smart money have their unfilled orders and to be particular along with them. Knowing when the smart money equality provides are moving the markets is critical, so you can be there to ride along with this. So this is the middle mindset you must have. You enter where and when the liquidity provided to the smart money are providing the liquidity, everything you see on the chart to the left has already taken places. The only thing that matters is where those unfiltered orders are resistance in the market, because this is where the price actions goes and makes off from the. Let us to start with the different methods of the identifying and plotting areas of the supply and demand. Of the easiest zone to stop is when you have to obvious change in the directions of the trend. For a supply zone, you need 2 points first to exact the points of the market. Drop quickly out to the small range. I use the price open to the last bullish candle before the drop, and the second one uses highest candles which can range for the demand zone. You can find a point to the market rose quickly out of the small range, meaning the open prices of the last bearish candles before the prices increase, and the second point of the lowest candles weeks of the range. In both cases, you look for the large candles body or the gap away from the zone as the future indicators of how strong the price actions is in that value area. The next method of identifying zones is to look for the area where prices has been trading sideways and in the narrow range for the several years, and then dramatically shoots away from that range. On the left side of the chart, we see that the price trading in the narrow range for the several years and then down dramatically. The next time price came into the zone, the trend reverse given to the short opportunity. The third method is to look for the areas of the indications range previous or the small corrections during the strong downtrends for the supply zone, or region periods or small corrections during the strong uptrend for the demand zone. These are the really based really and the drop-based drop structures. The last methods by the looking for the gaps between the stock gaps easier up or down. There has been sudden changes in the balance of supply and demand. The price each gap from is very likely to be the strong supply or demand zone. Watch this video if you want to learn more about the market structures and supply demand trading. So then price actions come back and to revisit the value area again in the future, so you will be there waiting for the reaction. You must anticipate several things: who is in control right now, how to do the trend, where's reverse to the each other is most momentum gain or losing strength. how is the price reach around the previous highs and lows. There are more important clues that will help you understand the buyer and the seller dynamics. After you identify zone, to watch for the how far price actions breaks into the value area on the first retracements. If the price actions doesn't quite reach to the value area, there may be more unfilled orders left in the value area, and the price could come back here to fill more orders. Very important, the first retrace back to the value area is the highest probability of the trade working out. On the second or the third retests the probability of the trade working in the decreased supply, and the demand level becomes invalid once price actions break through and close above or below the tested level. This is because all orders that were left in that level has been absorbed. Those the candles can close above the value area. What happens when the value area is not fresh and price has been back into the one or more times? Chances are price we straight through the value area because all of the previous orders that were placed there have been filled, absorbed. One of the most intelligent aspects of the trading is that there are so many different opportunities. Some traders prefer to focus on the supply and demand and price actions, while other traders prefer to focus on the technical indicators. As the price actions trade, we basically have two ways to trade, with or without confirmation signals. When trading supply and demand, you have two choices: to enter when the price returns to the zone, or to confirm the setup with another signals. It's important to understand that each trend, its supply and demand zone is unique. There will never be the two trading situations with exactly the same in the market. So where you are enter or the confirmation signals or without one is going to be determined on the case by case basis. You might choose to the wait or the confirmation signals and supply or demand level, or you might just enter the blind way at the key level. I prefer to have confirmations from indicators, and one of the best ways to doing this is through establishing confluences, first confirmation zones from the MACD. Trade confuse simply refresh to the overlapping or of the technical elements at the same prices and the time point giving the same signals. In this case, a supply or demand zone and the signals from the MACD indicator. After all, if we have two or more non-correctable signals or suitable giving as the trade signals, the chances of the working are increased. Now, MACD can be used to confirm the trends, directions, and the momentum. You can receive a lot of the different signals from it. I've taken about the MACD signals in this video for supply and demand trading. I found that the MACD divergences are perfect within signals to confirm our setups. MACD and momentum indicators shows the momentum of the price over time, and how strong those momentum are on will be regardless of the directions of the price moves up or down. Divergence refers to the any instance where the price reach a new high or the new low, but momentum, as illustrated by the MACD, doesn't perfect the same exact when the price and momentum divergence. It typically indicates that the market is primed for the several years. We have the demand zone on the euro, yen, and daily time frame. Then the using MACD divergence with the supply and the demand zones. I use the multiple time frames approach to the area to the major rules for the multiple time frames analysis. Larger time frames establish the domination of the trends, and reverses start from the smaller time frames. and continuous upwards. So you find your supply and demand zones on the higher times frames, the daily charts. Then you move lower time frames. In this case, the 30 minutes chart to find the MACD entry signals. This is very important. You watch for the price actions to turn on lower time frames, but a higher time frames supply or demand area. And when trend is changing, you look at the higher time frames. See where the previous value area was, because price should go there on the lower time frames chart. On the 30 minutes chart, we noted that the MACD as a momentum indicator turned to the upside, or the longer continues to the following to the downtrend price momentum. It means that the indicator divergence from the price momentum and showed that the momentum of the current price movement was varying. We also had engulfing candles rejection to the area, which is the third confluence factor in the setup. This was the valid trade, and we entered the right after the rejections with the stop losses below the influence barge. Here we have another demand zones on the pound dollar to the daily time frames. Again, we will use the multiple time frames approaching the daily chart. On the right, the larger time frames will establish the trend, and the reversal starts from the smaller time frames first and continue upwards on the 30 minutes chart. Here to the MACD divergence instead the demand zones, which means that the momentum of the current prices movements was failing to make the histogram turned another bullish confirmations price, then started to make the higher highs and the higher lows another bullish signs as they check out many confluence factor to the entry instead of the demanding areas turned out to be the great trend. It goes without the saying, you can replace the MACD with any other momentum indicators if you don't like to use instead of the stop into the amendment. For example, second confirmations comes from the stochastic. Stochastic also measured the momentum of the price. Although I don't rely much on the overbought and the oversold conditions, these signals tend to work in combinations with the supply and demand zones. Now stochastic isn't overbought and oversold. It has absolutely nothing to do with the market getting really for the reversal, not even in the slightly way trading with these levels without the price action is a guarantee way to lose money trading. So because I don't trust these levels much, I increased to the permanent for the overbought and oversold from 20 to 80 to 10 and 90, and it also increased to the length of the stochastics to the 15, 5 and 3. These ways indicators won't reach the level or so as often. There's to see the example of the stochastic confirmation by the signal at the demand area. We will use the same multiple time frames approach. We will trade to the directions of the higher time frames, especially for the trade like this. That would be considered against the previous downtrend leading up to it, to see the confirmation signal before entering. We can see the nice up move which followed this oversold stochastic signs. You could also wait for the trend line breakout if you really want to be sure that the bulls are taking full control. There's another example. We found the supply zones on the 4 hours time frame on the right side on the 30 minutes time frame, and first retest of the supply zone stochastics was well over 19 prices found the new seller in this area. We had a nice slide to the downtrends. We even had the third and the fourth and the retesting area. If you want to trade to the supply area market, sure, the zone is still fresh, which means that after the initial creation of the zone places has not come back to the yet. Each time prices revisits a supply zone more and more previous unfirmed orders are filled, and the level is weakened continuously. But if you have confidence that the supply area will hold, you could re-enter with lower positions. The force protest came with a massive move to the downside. If you learn something new, and hit the like button, since it really helps us to subscribe to stay to the date without the latest release, and check out the Academy program if you want to the future level up your training.